13th. It's been 8 days. It feels like more and less at the same time since the election, as we let people trickle in here or pour in here. Kind of expecting decent turnout for this topic. As people are trickling in, I guess it's a little bit of a departure from our usual subject matter. Obviously, we'll touch on some things that overlap. Peter, when you were on the West Coast for the election, right?
Yeah.
Do you? I'm thinking back to 2008, and this is partly just the quirk of timing and things. But I remember having some friends coming over for the 2008 election, and I think Pennsylvania was called at like 5:30 p.m. West Coast time, and things were basically over at that point. And everybody was just kind of like, "All right, here we are." Whereas I feel like the last 3 elections have been a little bit
tighter,
suspenseful.
I was on the East Coast for 2008.
2008, I remember being a quick call. 2012, I was on the East Coast. I don't remember it being especially.
Yeah, it was pretty quick too.
Also fairly quick, and then, and you weren't an eligible voter for 2004, right? I think
2004. I was 16.
You were 16. Yeah. I had just aged in. Well, we're just vamping here. We'll give people another maybe minute or two to trickle in, as we always like to do, I guess. For those who have arrived so far, feel free to chime in the chat and let us know who you are, where you are. We always see some familiar faces. It's good to see that, and of course, anyone new, announce yourself, and we'll get to know you too. While we're waiting for folks to come in, I'll just put up our usual call to action in the bottom left there. If anything we say here, or anything you've heard from us over the days, months, years resonates, always feel free to schedule a call. And there's about a 60% chance that you'll get me or Peter directly on one of those calls, and if not, then one of our expert colleagues. So don't hesitate to do that. That's 2 minutes. Peter, maybe we can get rolling. None of this is going to be the kind of, I think, specifically actionable and linear guidance that we give on our other webinars. So it's totally fine if people kind of trickle in over the next few minutes. But for everyone else who's here, and it's a good and growing number, welcome. As you know, as many of you know, this is, the 7th or 8th in our series of webinars on the subject of tax planning. Valor, of course, is 100% focused on tax planning for individuals and their business, ordinary income, capital gains, and estate tax. And given that focus and all of the talk of tax as part of the 2024 election season, we thought it makes sense to talk about this subject as soon after the election as we could. So we're here. Many of you, I think, have seen either me or Peter or both speak before, so we won't belabor the introductions. I'm Jeff. I'm part of the founding team here at Valor and our head of product. I'm also a lawyer by training, and I live in Washington, D.C., and as a result, I'm fairly tapped into what's going on here on the Hill, at the White House, and in the election. And I have with me Peter Tucci, who is our head of estate planning. He's in California, a little farther away, but very, very astute on the implications for tax policy. So let's get into it. The agenda here is relatively high level. Like I said, we're not going to be going deep on any particular tax strategies here today like we do normally. Our goal here is to talk at a reasonably high level about the major categories of tax and policy changes that we expect the Trump administration either to explore or to support outright, or for Congress to pursue in some cases, whether or not they have the administration's support. We'll then go deep on 3 or 4 of those changes that we think most directly impact what we think of as high leverage tax planning and individuals with high leverage needs. So while we'll touch on little things like the changes in tax brackets or the proposal to remove the tax on tips, our focus is really going to be on the kinds of things that are going to have outsized impact on our clients and the people who signed up for this webinar, which tends to include folks who earn a good living, who have large capital gains coming up, and also who have good and growing personal estates for which they're going to kind of need to think about their estate tax. And then we'll, as usual, we'll always leave time for Q&A throughout and then at the end. And definitely feel free to chime in with questions as we go. We'll do our best to answer in real time, and if not, we'll save those for the end, and we'll dig into it. Planning to go 45 minutes here. We'll see kind of how much engagement there is on Q&A and whether we need more time than that. But let's dig in. So, Peter, this is something that I wanted to tee up for you to talk about, since you are really tapped into the kind of history of Republican control of the levers of government, and especially the last kind of 10 years of tax policy. The context here is that the Republicans took over the federal government. Now we're still waiting on results on the House, but they're in control, and there are a number of concrete proposals on the table. So why don't you talk about, kind of where things stand in terms of control, and then we'll talk maybe about those implications.
Yeah, so I guess I'll sort of going a little bit back to give some more background on this. So in late 2017, when Trump had just been elected, and Republicans controlled both houses of Congress, they passed a major significant tax reform called the Tax Cuts and Jobs Act, and they passed it under a budget procedure called budget reconciliation. But the basic idea is that they were able to pass it with a bare majority of votes in the Senate, so they didn't have to worry about the filibuster, which requires 60 votes to overcome in the Senate. And so, anyways, they were able to pass this pretty ambitious agenda. The catch was that under the budget reconciliation rules, the changes mostly couldn't last forever, and so they can only last for basically 10 years. But because of sort of technical budget rules and the way that certain tax changes have trailing implications, they had to make them expire at the end of 2025. And so about 8 years after they were enacted. And so now we're, 7 years later, 8 years later, really. And all these changes are coming up for renewal. And so the question before the election was, if Democrats win, will they extend these changes? Probably not for most of them. If Republicans win, will they extend the changes? And the answer is that Republicans support extensions and a few other changes too. The issue is that while Republicans have a pretty comfortable majority in the Senate, 53 votes, their House majority is pretty narrow. It looks like it's going to be maybe 221 Republicans in the House and 214 Democrats or something close to that. And so that leaves not a lot of room for error. And a related issue is there's large deficits, and a pure extension of the 2017 law would increase debt even more. And there's a lot of Republicans in the House and Senate who are worried about deficits, and so the deficit issue creates some challenges politically, especially because they can't afford to lose more than maybe 3 members of the House. So it'll be interesting to see what happens.
And so, Peter, I guess, first of all, real-time updates. I just saw another vote dump in Pennsylvania with Senator Casey making up significant ground. So it sounds like some folks are maybe walking back that call. That's not going to change the balance of power. It's either going to be 53-47 or 52-48 in the Senate. As you said, the House is very likely to be about 220, 221 for the Republicans. I think there are two kind of types of question here. One is about process. How many votes would the Republicans need for what they want to implement? And then the second is, are they going to get whatever that number is? And so on the first question, you mentioned reconciliation. And so there's a kind of a factual question and a process question here, which is, are the Republicans talking about using reconciliation again? And if so, is that something that we expect that they'll be able to do?
Yeah, so basically they're going to have to use reconciliation in order to get these changes through, unless they can get 7 Democrats in the Senate to vote for it, which isn't going to happen in today's political environment. So they have to use reconciliation, which means most of these extensions will be temporary extensions, probably through around 2033.
Mm-hmm.
Some of the changes might be permanent if they're able to find permanent financing for them. But most of the changes will be temporary. They only need bare majority, so 50 votes in the Senate plus the VP, and in the House they just need 218 votes. So they can, depending on where things come out in the House, they probably have about 3 votes to spare in the House, which isn't a lot.
Yeah, I'm gonna throw another real time question at you. I'm sure you've been thinking about this. Does the Senate just decided on a leader in the last, I think, few minutes? In your view, does that the outcome of that fight with the more extreme candidate losing, I suppose, does that alter your view of kind of how this plays out at all?
I don't think so. Yeah, Thune is kind of the establishment candidate, and so I think he's not going to disrupt expectations very much.
Yeah. Yeah. And just to kind of lay the groundwork for what we're going to talk about in the specific proposals that we'll get to, in general, there's not a lot of daylight, am I right, between the administration and Congress on these questions. Of course, around the fringes, there's the deficit hawks, there's the Freedom Caucus, there may be some battling on the margins, but for the most part, am I right that the administration either hasn't taken a position, in which case you'd expect that they kind of go the Republican line, or has come out in favor of the sorts of things that Congress is putting on the table here?
Yeah, I think that's right, and I think internally, Republicans have had a lot of these debates over the last few years, and so I think most of the big potential snags have already been sort of pre-worked out. But there's still a bunch of stuff that is a little bit up in the air, including how much they're willing to increase the deficit.
Yep, the deficit is one. I think something that's maybe slightly contentious and doesn't cut perfectly across party lines is something that Davey just mentioned in the chat, which is the SALT deduction. Might be worth using that as a segue, and we'll answer that. But as a segue to talk about some of the specific proposals and changes that are to be expected. We've divided these into big substantive categories that tend to track the kinds of things that we think about. The Tax Cut and Jobs Act individual provisions, which Peter will talk about, are kind of background to context for everything that we do and everything that you all have to think about when you're paying your taxes and doing your planning. But then numbers 2, 3, and 4, numbers 2 and 3, estate tax, business, capital gains tax, there are some potential either changes or extensions that are maybe different from what you'd have expected if the Democrats had won, that will significantly affect the opportunities to reduce your taxes going forward. So, Peter, you want to take on the number 1 there?
Yeah. So to mention, to address Davey's question on SALT. So SALT is the state and local tax deduction. It used to be unlimited. So if you lived in a high tax state, you could just claim like hundreds of thousands of dollars of federal deductions for your state income tax and property tax. So in 2017, the Tax Cuts and Jobs Act imposed a $10,000 cap on state and local tax deductions, which was controversial, but it raised a lot of money and helped to address the deficit concerns at the time. And so there's been talk about loosening those restrictions. Most people think that Republicans basically have an internal agreement on SALT, which is they're going to keep the $10,000 per person cap, but for married couples will get $20,000. So two $10,000 deductions. And so, instead of it being $10,000 for a single person and $10,000 for a married person, it's going to be $10,000 for a single person and $20,000 for a married couple.
Yeah.
But we'll see if that's actually how much that's really been worked out. But that's what people think that the tentative deal is.
And then more generally,
Yeah.
there's a lot going on here having to do
Yeah.
with the potential for changes in the marginal rates, potential individual credit changes. We're talking about things
Yeah.
like child tax credit, which was actually the subject of pretty robust debate on both sides during the election season. Standard deduction may change, itemized deductions, AMT. These are all in a suite of what I think of as things that affect the rate that you're paying on your taxes. And then there's kind of bigger structural things that we'll get into. The first one, and we'll just hit on this very quickly because we're going to go deeper on each of these, is the estate tax. Just in general, as I think you all know, there's an exemption that every individual taxpayer has where they can give away a certain amount of money without being subject to estate tax. That number is the subject of some kind of political football. We're going to talk about business and capital gains taxes. If the Democrats had won, there may have been more of a likelihood that capital gains rate might have changed. Probably not going anywhere now. But business tax and deregulation are a pretty robust or a big subject right now on things like bonus depreciation and opportunity zones, which again we'll talk about in more depth. Just in the interest of time, I don't think we need to go too deep on the kind of more slightly out there proposals like no tax on tips and overtime. Peter, am I right that all may or may not happen? It's not really likely to have any broader impact on.
Yeah, I don't think there's going to be a lot of tax planning to do around like no tax on tips, for example.
Yeah.
I think that the no tax on tips one in particular got so much media attention on the campaign trail that I think Republicans will probably have to do something on that just to otherwise people will be asking them why they didn't exempt tips from taxes.
Mm-hmm, mm-hmm. But I mean, to take a step back, in general, there are a number of things that are likely to change and very often change when you've got expiring tax provisions and also a change in government at the individual level that are important background, but for which there's maybe not that much to do, right? Tax on tips over time, if your marginal rates change, the deduction changes. Those can change things on the margin. Maybe you should be more or less likely to use a Roth IRA, depending on your marginal rate, those sorts of things. But what we want to dig into here, and having talked about how likely any of these things are, is we want to dig into the meaty ones, the big ones that either present opportunities for or challenges to the chance for individual tax mitigation. As you all know, this is our business, and it's what we know really well, and it's why we assume many of you are here. And these four things on this slide really could have massive implications in the millions, tens, or hundreds of millions of dollars for individual taxpayers, depending on what kind of gets through Congress and how it's implemented. So we wanted to make sure we had time to touch on each of these. The first is the estate tax exemption. Peter, I'll give some context here, and then of course you'll dig into the implications. As I pointed out, and I'm sure almost all of you know, when an individual or a married couple gives money away in the U.S., they get to give a certain amount away, completely tax-free. But any dollars that they give away over that limit, whatever that limit is, are subject to tax. The federal rate is 40%. Many states have their own estate or inheritance tax. Those add up potentially to a 52% tax on marginal dollars that you're giving away during your life and when you pass away. The current exemption is around $13.6 million per person, 27 million for a married couple. That's set to sunset at the end of 2025, as Peter pointed out, and would automatically drop down to the $7 million per person range. That would be a really, really big change for families between those two numbers, or families who expect to have somewhere between 7 and 14 or between 13 and $26 million during their lifetimes. So the big question, Peter, is what do the Republicans want here? What are they likely to pursue? And then, of course, what does it mean for individual families?
Yeah, so they're very likely to try to extend the current law, which is the current 13.61 million, which is adjusted for inflation every year, and so that's pretty likely. The only scenario where that isn't extended is if things just fall apart, and they can't pass a bill through Congress.
And are
But
we expecting an extension, really kind of truly an extension, keeping the limit really right where it is now?
yeah, I think it's going to be right where it is, and it's probably going to be extended through 2033 is my guess.
And so what that means for families, for married couples, they're still going to be able to give away $27 million or so, free of estate tax, and anything above that would be subject to tax. Is there? So I guess talking about the implications a little bit, if you were going to be under that $13 million limit, then if things stay the way they are, then there will be no change, right?
Yeah.
If you were expected to be over that limit during your lifetime or when you pass away, if your estate is going to be more than 13.6 million per person, you would have had to do planning before, and you'll still have to do that. We don't expect that number to go up. I guess one question that arises out of this, aside from which strategies you might want to think about pursuing, and we have a list there, and you can read more about that on our site. There's a question of timing, given that the extension is also likely to expire, and you never know what this exemption is going to be going forward. How should an individual who does expect to be, let's say someone expects to be somewhere between 10 and 15 million dollars per individual, or 20 and 30 per married couple, and is young now and expects to live well past that next expiration date, are there things they should be doing today or thinking about today to get ahead of the next sunset?
Yeah, so I think if you're 40, chances are if you live a normal life expectancy, the estate tax exemption is going to change 4 or 5 times over the course of your lifetime. And so it's hard to really predict where it's going to wind up, in 2075. But I think it's always a good idea if you're pretty high net worth. It's always a good idea to make gifts, at least to some extent. And the more high net worth you are, the more sense it makes. But it always makes sense to get assets out of your estate and to trust for the benefit of your children or other loved ones. And the sooner you do that, usually the more efficient it is. These assets tend to appreciate over time, and so if you can transfer assets when they're at lower values, that's more bang for the buck than transferring them years later when they're the same assets.
And that's going to be true. That's going to be true more or less, no matter what the exemption is. I think one interesting kind of result of this election, if the Democrats had won, there was talk of letting the current number expire and just leaving it at the 7 that it's going to revert to. I think that would have been a meaningful change, in the sense that families that have $7 million or even $10 million today look very different from families that have $25 million today, or that are going to have $40 million if the number goes up with inflation, say, over the next 10 or 20 years. And so for the families that are at that low level, the Republican win may actually have a real large and meaningful effect, which is, you may not need to do any estate planning if you're going to have, let's say, $7-10 million in your estate. So I guess the question is, how do you think about if you're advising one of those families that would have been subject to the estate tax if the number had come down? We don't know where the number is going to be in the future. Do you stand by the view that even those families should be doing things like crummy gifts or basic gifting, kind of no matter what?
Yeah. So if the current level is extended to 2033, there's about a 50% chance that it won't be extended beyond that. It just depends on who wins the 2032 election, I guess. And so unless you're 90 years old and you think you're gonna die in the next couple of years, I still think it makes sense to do some sort of hedging against future estate tax risk. Just because something like a crummy trust, which, if you don't know, is a trust that you create that uses your $18,000 per beneficiary annual exclusion. So it's just a way to get $19,000 out of your estate in a trust for the benefit of your kids. I think sort of like low difficulty, sort of inexpensive strategies like that make a lot of sense to hedge against future estate tax risk.
Yeah, that's right. We won't belabor this one too much, but just kind of background context for everything that we're talking about here today is, of course, unsurprisingly, Valor can help with this, and so it's worth digging into these strategies, checking out our writing on estate tax. None of this is going away, and it's, as Peter said, a lot of this is low hanging fruit and worth pursuing really from day one for most families. So if you've got questions, if you've got clients, or if you expect to be subject to these limitations during your lifetime, it's worth thinking about now, and of course always potentially getting in touch with us at the link right there. The next big set of changes, moving away from estate tax and to personal and business income tax, has to do with bonus depreciation. Republicans in general are viewed as the more pro-business party. Whether that's ultimately true or not, I think one thing that we do expect is that some of the simpler pro-business tax policies that were part of the Tax Cut and Jobs Act, or that have been promulgated over the last decade by Republicans, are likely to either be extended or re-upped. This is one of them. This is so speaking about bonus depreciation, I guess we'll start with what is it. Many of you know, some of you don't, but I think it's a big opportunity for individual tax planners and clients planning for taxes. Depreciation, as I think most of you know, is the concept that physical assets, really lots of assets, lose value over time, and you're allowed to deduct that lost value from your income. So if you own an asset that's losing $10,000 of value every year, you can take that $10,000 and deduct it out of your personal income or your business income when you're doing your taxes. Bonus depreciation is the concept which has grown in salience over the last few years, that in some cases you can bring that depreciation forward and take it really up front. If you buy a piece of real estate or some other physical asset, some machinery, traditionally you would have depreciated that asset over potentially as long as 27, 28 years. And so the deduction every year would have been very small. As part of the 2017 tax bill, and this has gone back and forth over the years, Congress enacted this concept of bonus depreciation, which allows an individual to bring all of that depreciation forward to the first 5 years. Originally, it was 100% in the first year, but that number has decayed and sunsetted as a result of these expiring laws, to where this year it's 60% in the first year and the rest over the next 4. Next year, I think it'll be 40% and so on. Peter, the expectation that we have, I think, is that Congress will, as part of everything they're doing on taxes in the coming year, will bring bonus depreciation back and re-up it to 100%. Is that right?
Yeah, that's what people think is going to happen.
Yeah. And so if Congress brings bonus depreciation back to 100%, or even if it goes back up to some other number, that's going to have implications for the kinds of tax planning strategies that benefit from and focus on depreciation. So real estate is a big one. There are lots of opportunities to take very large depreciation deductions from real estate. And if you're able to bring all of those forward, that can make an otherwise pedestrian real estate investment look really attractive. Buying physical machinery. We've had clients ask us whether they should go out and buy a crane, which is a little bit out there for Valor, but is something that people do when depreciation is a big part of the benefit. And if bonus depreciation is 100%, then going out and buying machinery could make sense. Similarly, and maybe closer to our hearts, is green energy projects. As many of you have heard us talk about, there are substantial depreciation benefits as well as other benefits from investing in solar specifically, among other things, as a result of both the Tax Cut and Jobs Act with this bonus depreciation and the Inflation Reduction Act, which the Democrats passed in 2022. The solar is a way to take advantage of this, even if you aren't buying real estate and you aren't in that business. And if bonus depreciation ticks back up to 100%, then the solar projects that we help you find, which were already very positive ROI, we're returning, on average $1.30 for every dollar invested in the first year. That's great. And if bonus depreciation goes back up, those numbers will just get even bigger. And the balance between real estate and solar and oil and gas and other strategies may shift. So keeping an eye on this is important. And if it does go back up, then the expectation is that more of you all and more of our clients will be interested in pursuing solar. Peter Pranav asked whether we expect that bonus depreciation will reach backward if they do re-up it. There was talk this year of if there had been a new law passed, and there was some possibility that was going to happen, even with kind of split government, that if they went back to 100%, that might be applied to last year as well. Do we expect that might be the case going forward?
I mean, I don't know. My guess would be no, because they're going to be trying to keep the cost of these extensions as low as possible, and that would increase the cost.
Yeah, and that is kind of a background fact that's underlying all of this. Peter mentioned the deficit hawks. We speak a little bit flippantly about that part of the caucus. It's a not insignificant part of the Republican caucus, and anytime a party's out of government, they tend to start to become deficit hawks a little bit, and so you'd expect that the Democrats wouldn't be interested in signing on to kind of more aggressive moves here. That being said, bonus depreciation is very popular among a core constituency of the Republican Party, and so I don't think it's out of the realm of possibility, Pranav, that we'd see this kind of horse traded for something else. Maybe the SALT deduction doesn't happen, or the extension doesn't happen, and this does look back. I think the answer is we don't know, but there's a world where you might think the answer would be yes. Probably more likely no, as Peter said. But in general, bonus depreciation is a real opportunity. All of these asset classes are already advantageous for lots of tax reasons and other reasons. They become even more so if bonus depreciation gets larger. So the next of our four big subjects here is something that's related to what we were just talking about, which is Congress going to modify, eliminate, extend the Inflation Reduction Act's green energy subsidies? As I mentioned, and as I think almost all of you know, the Inflation Reduction Act, which was passed at the end of 2022 and came online in the beginning of 2023, includes really just very, very large tax incentives for investment in green energy projects. Whereas before the Inflation Reduction Act, you could get a 10% credit for investing in a physical solar project, for example, and that's been true for 20 years. The IRA increased that number to a baseline of 30 and offered a path forward for projects to achieve as large as 70% tax credits. Many of our clients and many of you, I see a bunch of people here who have taken advantage of this. If you put $1 into solar, you're potentially, with leverage, getting back, like I said, as much as $1.30 just in the first year from investing in green energy, and as much as $1.60, $1.70 over the next 4 or 5 years, because of the increased subsidies and the bonus depreciation that we've just talked about. A major question, so the Inflation Reduction Act subsidies are slated to continue for the next decade. A major question is, will the Republican Congress and administration seek to modify or end those subsidies? There's certainly an element of the Republican caucus that would be interested in doing that, Peter, right? But at the same time, these subsidies have been broadly used and in general are pretty popular. So reading the tea leaves, what do you think is likely here?
I don't know. I think, first of all, I would say that these sorts of tax changes will be prospective. So if you did a deal this year, last year, I think you're pretty safe. But it's hard to know what Congress is going to do. The Inflation Reduction Act overall was very expensive, and so I think if you're congressional Republicans, you're looking for ways to extend the Tax Cuts and Jobs Act without increasing the deficit too much. you might think going back into the Inflation Reduction Act and reducing some of those subsidies might be a good way to do it.
Mhm.
But
do you think so? This is one of the areas where I think there's an okay chance that we might see some mixing of party lines. There were Republican votes for the IRA in 2022, and some Democrats defected in order to repeal these provisions to get rid of these subsidies. The Republicans own all three branches. So I guess what would be the procedural posture here? How would they do it, and what numbers would they need?
Well, yeah, presumably it would be bundled into the tax cuts, and so it would be an offset for the tax cuts, and so it would be part of the same budget reconciliation process.
Right. And so then they'd need a bare majority. I guess looking first at the Republican side, do we? I'm putting you on the spot here. We haven't talked about this. Do we expect a vote on party lines on the Republican side for that sort of thing, ignoring the kind of complication of deficits and things like that, just in terms of pure energy policy? And I guess tax cut offsets is a part of this. It's hard to ignore. Do we expect 53 or Republican votes in the Senate and kind of a bare majority in the House?
Yeah, I think it's plausible. It just depends on what it is. Like they don't have to blanket repeal the IRA. They could repeal certain parts that have more sort of consensus.
Yeah.
So.
Yeah, that sounds right. Then again, the Democrats, like I said, also lost some votes on this last time. So even if some of the Republicans defect, we could see some kind of cross-party voting here. I don't know. This one is really tough. Talking to folks in the energy industry here, I think there's not a consensus, but what I'm hearing is that there's a decent chance that they chip away at some of this stuff, either by shortening the subsidies, which are scheduled, like I said, currently scheduled to run until I think it's 2032, potentially sunsetting more quickly, which would help with scoring, or potentially reducing but not eliminating those subsidies. Maybe limiting the higher end of the investment tax credits, right? 70% credits, which are available, if not quite online yet today. That's a big part of what makes this expensive, and potentially Congress could get some kind of deficit hawk points just by limiting those things around the fringes. So the answer on this one is we don't know. If Congress does step in and if these subsidies do get curtailed, then that does hurt the ROI, the return on investment from green energy investing. Right now, solar purchasing for tax purposes, on just purely on the numbers, is close to a no-brainer for a lot of people. If the numbers come down, it may still be. If these credits are eliminated entirely or go back to the level they were at pre-2022, then we go back to a world where this may be back to the province of just corporations and really high net worth individuals, and not so much for retail investors, which is what we've seen over the last few years. And of course, if that happens, then very likely money will flow to what we think of as substitute tax planning strategies like oil and gas, real estate, and some other things. Again, we don't know, but we're going to continue to press ahead. And also, as Peter said, almost invariably, these sorts of changes are prospective. And so if Congress takes 6 months to get its act together on this stuff, or does reconciliation at the end of next year, which is what happened in 2017, right? They passed a bill in late December 2017 that went into effect on January 1st, 2018, which was 1 year after President Trump took office the first time. Then certainly this year's projects and even next year's projects will still get the benefits that they expected. And so it's not something you need to worry about losing after you've already put money in, but it's something to keep an eye on going forward as a strategy. With 5 minutes left here, and of course, keep chiming in with questions if you have them. The last subject that we wanted to touch on, which is only barely a tax planning subject, is oil and gas deregulation. This is really not a tax cuts or tax policy issue. The reason we're talking about this here is that a significant portion of the dollars going into tax advantage projects, often for the purpose of reducing tax on ordinary income, goes into oil and gas projects. Those projects have become more attractive over the years as it's become easier to drill for oil and gas, and as the likelihood of those projects coming off and producing significant product have gone up, as fracking has become more accepted and as other technologies have been deregulated. We're seeing oil and gas projects produce more oil and gas. We're seeing fewer dry wells. And when you combine that with the tax benefits that you get from this sort of thing, which I'm not going to go deep into today, but you can read about, when you combine all those things, this has become a reasonably attractive tax strategy, especially toward the end of the year when things like solar and real estate might be a little bit tougher. The Trump administration, or the incoming Trump administration, has talked pretty concretely about expanding oil and gas drilling, and in particular reducing regulation on those projects. The language around this sort of policy really focuses on the kind of populist, we're going to cut energy prices, energy bills, but that doesn't really matter for tax planning. The implication here, though, for you all is if those regulations do get removed, if the oil and gas industries are able to drill in new spots, if they're able to use technologies that they weren't before, and there are specific proposals on the table, it's likely to make these projects more attractive. The numbers will just get bigger. The tax benefits aren't going anywhere. This isn't part of the Inflation Reduction Act, so it's not something that's on the chopping block really at all. So if you combine the same tax benefits, which, just for everyone who doesn't know, can be as large as more than 100% deduction for every dollar that you put into oil and gas. If you combine that with increased production and higher returns from investing in a fund that buys and builds oil wells and gas wells, then you're going to see this asset class have larger ROI and potentially be more attractive as compared to, again, the alternatives. So, like I said, that one is much less about kind of specific tax policy. It's not about reading Congress. It's more just a kind of a vibe shift with any Republican administration taking office, but especially this one. Potentially the move to kind of re-deregulation of that industry could be consequential. So hit the mark almost perfectly. 2.5 minutes left. Like I said, keep coming with questions if you have them. I know a lot of this is less concrete than what we normally talk about. We're speculating, certainly, and we'll have more to say on this in the coming months as it becomes clear what's likely to be happening in Congress. We'll likely just do this again middle of next year once proposals are on the table and as reconciliation kind of becomes clearer. In the meantime, I think we've given you a decent idea of which of the kinds of individual tax planning strategies that we offer and some that we don't are likely to either rise in value or decrease in value over the next year or few years. And so, to sum it up, I'd say in general, as Peter said, always worth getting your estate tax planning started because you never know where the exemption is going to go. If bonus depreciation comes back, then looking very closely at real estate, at solar, will make a lot of sense for high earners. And by the way, just to put a pin on that one, when we say high earners there, we mean anyone who's making probably north of $300,000 or so. Should be looking at this if bonus depreciation comes back. Even if it doesn't, then families earning $500,000 or more still are candidates for these sorts of strategies, and it's worth looking into. And then, I guess just to remind myself here, assuming the subsidies stick around and that there's deregulation in oil and gas, these things all remain on the table. And I think that's an opportune moment to mention that a big part of what we do at Valor is to help you wade through the alternatives here. Like I said, I run the product development side of things, and I'll just put in a plug for something that we're going to be rolling out in the next probably week or so, which is a more robust calculator that's going to let you compare the benefits of solar to oil and gas, to charitable remainder trusts, and all the other strategies that we like to talk about. This is all complicated, and we don't know what's going to happen. And so just getting started by looking at what's available and then getting in touch with us is always a good idea. And to that end, you've got the scheduling link there. You can always go to our homepage and click on the button in the top right. You can always email me and Peter directly. And and then, of course, joining us for future webinars makes sense. I see there are a couple of questions that just came in at the end, so let me look at those quickly. Peter, do you see, I guess, Jeff's second question? I heard there is not a bright line in the code for this, still being 2 years away. I don't know if you want to weigh in on that while I read the longer comment.
I think he's talking about.
Maybe this is all one comment. It's long.
Yes, I think it's also.
I've got to read it quickly. As we reach the end of the original opportunity zones, the person originally invested. In between time, that person moved to a no tax state. They can avoid the state tax component in an OZ. Yeah. So Jeff, I think this is a little bit outside of our wheelhouse. Happy to talk more about it. In general, with opportunity zones and all of the other strategies that we help you pursue, personal income tax rates follow where you live. And so, for example, if you do a charitable remainder trust and move the assets into the trust in order to avoid a capital gains tax when you sell your stock or your crypto or whatever it is, you're going to get distributions from that trust, and they're going to be taxed according to where you live at the time when you take those distributions out. My understanding is that that's similar with respect to opportunity zones, that the income is deferred, and then you'll be realizing those gains at the end of the opportunity zone investment. And so moving to a low tax state could make sense, but that's not a firm view. It's not something we've looked into deeply. We don't offer opportunity zones in-house at Valor, mostly because the benefits have just shrunk significantly as the 2026 phase out has approached. And so happy to talk more about that if you want to schedule a call, Jeff, but I don't have a strong view or a strong idea of that. Peter, do you have?
Yeah, the only thing I would add is, so a lot of these opportunity zones, they're generally invested in real estate, and the real estate is in some state, and so it might be California real estate, in which case, whether you live in California or not, that's California sourced income. And so, maybe if you're a Californian who's investing in a Florida opportunity zone, then maybe it could make sense. But a lot of these are going to be in states that have their own state income taxes, regardless of where you, the investor, live.
That's right. That's a good point. So I guess any more questions, chime in, but I'll just take a step back and say, we didn't talk about everything today. We really, in half a sentence, mentioned capital gains, right? Capital gains tax rates. We talked about opportunity zones. There are a number of levers to pull here, all of which Valor can help with. We help clients every day who are looking to offset their high ordinary income, their high business income from a small business that they own, capital gains from the sale of stock, cryptocurrency, real estate, and other assets, and then estate planning, which is just a massive, massive area for individuals, many of whom just haven't done any planning. All of this is complicated. No one knows what the world's going to look like in 3 months, let alone 3 years. And so we think, in general, we encourage you all to get in touch. It's always worth a conversation to see how we can help. In general, we're a really kind of high value, low cost, efficient solution for this sort of thing. And so it's worth scheduling a call and checking out what we do. Scheduling a call at valor.com and playing around with all of our tools, our guided planning, our calculators, and everything that we offer at app.valor.com. I was about to wrap it up, but I see that Jeff has one more question as I'm putting the app link up there. Is the payment for a residential solar system tax deductible? Lease payment. So Jeff, the way that we approach solar projects in general for our clients is that we're connecting them with developers who are building solar projects on other buildings, whether it's a residential building out in California or a commercial building, a university, something like that. And so the tax benefits here are really twofold. One is you get a credit from investing. That's the investment tax credit. Two is you get depreciation. And then the third thing is you do get revenue. Those lease payments are going to the tax equity investor. Oh, it's not Jeff. That's funny. This is showing as Jeff on all of these chats. It sounds like that's not actually him talking, and there's a little glitch. Thought you were just being super active, Jeff. So appreciate that. But no. So that income coming out of a solar project is taxable. but this is through a business, and as a result, you're able to deduct other things. So you can deduct your business expenses, your legal expenses, and things like that, your travel to sites. And so that's a way to offset that income. I doubt that directly answered the question of whoever was asking. I think that might have been maybe a little bit more about deducting lease payments on your home. But that's how we think about things, and how kind of you can benefit from solar. So I thought I'd go down that road. And since everyone, including Jeff, has kind of stopped chiming in with questions, I think we'll call it there. We appreciate you all taking the time, asking good questions as usual. Like I said, last plug for the next 2 webinars. We've got Grats on November 20th, right before Thanksgiving. We're going to be, I guess, that a week before Thanksgiving. We're going to be talking about how to pass assets to your heirs with Grats. Grats are a way to do this without using up any gift tax exemption. They're really valuable for families that have already done some gifting, as well as a kind of strategy combined with other types of trusts to get assets to your kids without using up any exemption, without paying any tax. Really powerful thing to do if you expect to be giving away significant assets over time. And then we'll be talking about the end of the year in December, especially on the estate tax side. Although it looks like the exemption is still going to be extended, we don't know for sure, and there are certain steps that, in any case, you want to be taking for you and your clients if you are over that estate tax limit, like Crummy and other simple gift giving. We'll be giving you kind of actionable advice on that front on December 4th. So come to the site, check that out, reserve your spot. We'll always share recordings of this and everything that we do if you sign up. So like I said, thanks for joining. Thanks, Peter, for chatting, and we'll see you all soon.